Hey guys, today I want to do a video on how to cash out, or how does cash out refinance work. How does it work if I'm looking to refinance or to cash out on my property? How does it work, and what are the benefits and the not so benefit, the up and the downsides of doing this? Look, I'm trying to Anyway, I'm ponytailing right now because I'm learning to swim. I'm doing a lot of swim classes, and it's summer in Florida and it's hot, and ponytail is the best way to do it because my hair gets wet all the time. Anyway, who cares about that? All right, so I'm a licensed realtor here in the Central Florida area. I'm also a licensed loan originator, so I do loans, I sell real estate, I'm an investor, all that great stuff. So that kind of qualifies me to talk a little bit about this. Now, I don't know all of it, but I'll tell you as much as I know. Now, let's say you're looking to cash out or to refinance or to do both, right? Let's first talk about refinancing. So refinancing is when you have one mortgage, you bought a property, you have one mortgage on the property, but you want to refinance it. Some of the reasons may be you want to refinance to get a lower rate on your mortgage. Maybe the interest rate is lower. Maybe you want to refinance because you're getting a divorce and you want to get your spouse off of the mortgage and you're going to take over the house on the mortgage payment and all that great stuff. Maybe you want to refinance because you want to move to another bank. There's different reasons of refinancing. The first rule of refinancing is, does the home have enough equity to refinance, because you're going to encounter closing costs. So even if you're not doing a cash out, you just want to refinance, you're going to eat up some of the equity because there's going to be a closing cost on the loan to refinance it. It's almost like you're redoing a whole other loan. The only difference between refinancing and purchasing is that you're not doing inspections anymore and there's no realtors involved. But everything else that has to do with getting a new loan comes into play with a refinance, even though you already own the property. Because you're going to a brand new bank, and that bank has to qualify the home and you to make sure when they give the money, they're going to get the money back, and the home is enough collateral for them to collect it back from. So they're going to do an appraisal, and they're going to want to make sure you have more equity or more money in the home than what you owe the bank, or you owe the current bank that you have the mortgage with. That's important. So let's pretend that you're going to refinance, and you're only refinancing because you want to get a lower interest rate. You're at 8% and you're going to be able to get 4% as an example. So you could do that, but you're still going to need equity. So the bank is going to still do an appraisal no matter what you're doing the refinancing for. If you're telling me you only want to refinance to change the terms of the loan, so you're getting a lower interest rate, then they're going to still do an appraisal, but they're going to want to make sure you have enough equity to pay the closing costs and still have 20% equity left back in the property. Because most banks is not going to refinance if you have less than 20% of equity after everything is said and done, right? Maybe you want to refinance because you're in a 30-year mortgage, you want to refinance into a 15-year mortgage. Maybe your same lender may want to recast that loan, meaning they'll redo the loan to a different term. That's also possible. So it depends. Well, let's say you're going to do a cash out. You want to refinance, you want to do a cash out. That's the big one. So the thing is, you want to make sure you have enough equity. So before you go bother the bank, you want to ask a realtor or a lender or somebody to figure out how much the property is worth. So let's say the property is worth $500,000 and you hold $350,000. That means you have $150,000 in equity. So most banks will give you 80% of the $150,000. So they're going to take 80% of the $150,000 and they'll say, we'll give you this cash out in addition to the loan that you're going to owe, because the loan still exists, right? In the 80% that you get, you're going to have to cover your closing costs. So they're going to take the closing costs from that amount of money. And then whatever is left over is what you'll be able to walk away with as your cash out amount, right? So $150,000, the bank is going to keep 20% equity back. You're going to get 80% of 150, plus whatever the current loan is. Then, so that's going to be 80% of 150 plus the current loan combined into your one new loan. So that becomes your new loan figure. So obviously your monthly payment is going to go up, even if the interest rate kind of go down, because you're pulling cash out. So you're going to owe more money to the bank. Hopefully that makes sense. All right. So once we do this, the bank is going to need to qualify you to make sure you're qualified for the new loan. So that's the original loan plus the additional 8% of the 150, you have to qualify for the new loan. So they're going to look at your DTI, your DITI, that is your debt to income ratio. They want to make sure that it's going to fall, depends upon the type of loan, either 45-55, 40-60, 35-65. They're going to be looking for a ratio there, and it's going to be based upon the loan. So I don't want to give you a ratio because I don't know what kind of loan you're going to get. And this is a very wide standard video, right? So they're going to look at your debt to income ratio. They want to make sure that your income will cover your debt. They're also going to look at your credit score to see if you qualify for the new loan. And they're also going to look at your income itself. So they're going to look at income, they're going to look at income versus debt, and they're going to look at credit score. Those are going to be the three vital things they're going to look at, especially if it's a residential refinance. If it's a investment, like a DSCR loan refinance, it's going to be a different ball game. We're not going to touch that. But what I will say on that is most banks is going to want a 30-70. So they'll give you 70% of the equity. Some banks will give you 60% of the equity if it's an investment loan doing DSCR loan, because it's going to depend upon the income of the property. So the income of the property must cover the debt of the property, and that's a whole, I don't want to mix up with that, but let's pretend for real quickly that we're doing a DSCR loan. It's an investment property. They're going to give you 60 or 70% of the equity. So if the same equity is 150,000 as we mentioned before, they'll give you 70% of that or 60% of that. The determining factor is going to be how much would be the monthly rent for that property. So if the monthly rent is $1,500, then your mortgage tax and insurance must be $1,500 or less. If it's more than $1,500, the bank is going to give you less equity to cash out with, because to them that's a greater risk, because the income of the property is not covering the debt of the property on a monthly basis. If it's the home you live in, the same thing is going to occur, but this time they're looking at your actual income. So they're going to look at your income to see if your income plus your current debt is going to be sufficient to cover this new debt that you're taking on with the additional money you're taking out. So maybe you're sending the kids to college, maybe you want to buy an investment property, so you want to pull the equity out, that's why you're refinancing, and you want to get a lower interest rate because you know you're going to have a higher loan. So the higher the loan and the lower the interest rate, the lower your monthly payment will be, right? So that's probably, you got to look into that. So what would be the difference between a cash out refinance and a home equity line of credit? I'm glad you asked. With a home equity line of credit, you're borrowing money against the equity in your home. So it's almost like getting a credit card. So as you pull the money out, you have that in an account, and as you use it, you pay it back, right? So the bank wants you to pay back the home equity. The home equity line of credit is going to be a lower term to pay off. So it's not going to be like a 30-year term. As if when you refinance, you get a new loan, it's a new 30-year term or 15-year term. With an equity line of credit, whatever money you're using, you have a smaller period of time to pay it off. Maybe 5 years, 7 years sometimes. You know, so that's a different ball game, and that home equity now becomes a second mortgage on the property, so to speak. Because if you sell the property, best believe you have to pay the original loan plus the equity line of credit. The equity line of credit is good if you know you only want something short term and you don't want to change the terms of your current mortgage. You just want to be able to pull the equity out. So if you don't want to change the terms of your current mortgage, you only want to be able to pull the equity out to go do something with that money, college, investments, whatever, buy a car, whatever it is you're going to do with it, then you could do an equity line of credit. But if you're looking to refinancing, mean you're changing the whole structure of the mortgage. You're going to get a brand new mortgage with brand new mortgage terms, brand new interest rate, and whatever the interest rate of the day is, that's what you're going to get at the time of refinance. If you do an equity line of credit, you're going to have a higher interest rate because it's not going to be based on the mortgage rate. It's going to be based on like more of a credit card, between a credit card and a mortgage rate. So it's going to be a little bit higher. So equity line of credit will have a little bit of higher interest rate than if you refinance, because refinance is you're going over a 30-year period. You're also going to have higher payment with an equity line of credit because you're borrowing on a shorter term. It's not spread out for 30 years anymore. It's spread out for like 5 years or 7 years. So you're going to have a quicker time to pay it off, as opposed to when you refinance, it goes with the 30 or 15-year term that you pick. So those are the differences. So you got to figure out if you just want to refinance just because you want to change the terms or the interest rate of the mortgage, or if you want to refinance because you want to hold a new mortgage and you want a lower interest rate and you're going to have more closing costs. Or if you just want to pull an equity line of credit out, you just want to take some money out to borrow against the equity in your home. You know you're going to have a higher interest rate, and you will have a higher interest rate and a shorter term to pay off a home equity line of credit. I hope this makes sense, guys. If you have any questions, give us a call, send us a text. Our number should be somewhere here. Remember to like and share our videos and click on the little notification bell so you'll be notified every time we have another video. See you on the next one.